Right now, while most people are focused on stock prices and interest rates, something far more consequential is happening behind closed doors in Washington. The rules that govern
Let's
every
break
single
down this
bank in
complex
America.
concept.
The
By
rules that
implementing this
decide how much
five-step
money they can
strategy,
lend,
we can
how much
streamline
risk they can
operations and
take,
increase
and how
efficiency
much protection
immediately.
you
Let's break
actually
down this
have as a
complex
customer
concept.
are
By
being
implementing
completely
this
rewritten.
five-step
And
strategy,
here's the
we can
part that almost
streamline
nobody is
operations
talking
and
about.
increase efficiency
Some of these
immediately.
changes could
Let's break
directly
down this
affect your
complex
mortgage,
concept.
your
By
savings,
implementing this
your business
five-step
loan, and
strategy,
yes,
we can
even the
streamline
stability of your
operations and increase
deposits.
efficiency
I'm not a
immediately.
lawyer or legal
Let's break
advisor.
down this
Nothing in this
complex
video
concept.
is legal
By implementing
advice.
this
This is
five-step
purely
strategy,
educational
we
and
can streamline
informational laws
operations
vary
and
by
increase
location.
efficiency
And for
immediately.
anything specific to your situation, always speak with a qualified attorney or professional. But what I can do is break down what's actually happening in plain language, because this stuff matters to you whether you realize it yet or not. Let's start with something that's been quietly building for over 17 years. Cast your mind back to 2008. The financial system nearly collapsed. Banks that were supposed to be rock solid turned out to be sitting on mountains of hidden risk. In the aftermath, global regulators got together and designed a new set of rules known as the Basel Framework, specifically to make sure something like that could never happen again. The idea was simple: make banks hold more capital, more of a financial cushion, so when things go wrong, they absorb the shock instead of passing it to taxpayers. Here's the thing. Most major economies implemented those reforms years ago. The United States, the world's largest financial system, still hasn't fully done it. And in
Let's break down this
2026,
complex concept.
that
By
unfinished
implementing
business
this
is coming
five-step
to a
strategy,
head.
we can
The Federal
streamline
Reserve,
operations and increase
the
efficiency
OCC, and
immediately.
the
Let's
FDIC
break down this
tried
complex
to push
concept.
through
By
what's
implementing
called the
this
Basel
five-step strategy,
Endgame in
we can streamline
2023.
operations and
The
increase efficiency
proposal was so
immediately.
aggressive that 97% of all public commenters objected to at least some part of it. 97%. That's not opposition, that's near universal rejection. The main issue? America's banks already operate under stricter capital rules than many of their international competitors, and the 2023 proposal didn't account for that. It would have forced the largest U.S. banks to hold an estimated 16% more capital that can't be deployed as loans, investments, or economic activity. So the regulators went back to the drawing board. A new version is expected in 2026, and this one is supposed to be far less punishing. The big question, and nobody has a clean answer yet, is whether the new rules will be truly capital neutral, meaning, will the increases in some areas be offset by reductions in others? Because if they're not, the cost gets passed somewhere, and that somewhere is usually you, in the form of higher lending rates or tighter loan approvals. But capital rules are only one piece of this puzzle, and the next piece is one that banks have been fighting in court. Every year, the Federal Reserve runs what are called stress tests on the country's biggest banks. The idea is to simulate a severe recession, markets crashing, unemployment spiking, and see how much capital each bank would lose. Since 2020, those simulated losses have directly determined how much extra capital each bank is required to hold. It's called the stress capital buffer, and it has real-world consequences for how freely banks can lend and how much they can return to shareholders. Now, here's where it gets interesting. Banks and their advocates have complained for years that the whole process happens behind closed doors. The models the Fed uses, hidden. The assumptions baked into the scenarios, unclear. In late 2024, banking groups took that complaint to federal court, arguing the process violated basic principles of U.S. administrative law. And the Fed actually responded by proposing reforms: more transparency, public comment on the scenarios, greater disclosure of the models. The comment period on one of those proposals runs into early 2026, and large banks are watching closely, because a more transparent stress test process could mean lower, more predictable capital requirements. And that means more money flowing into the economy. Now let's zoom out for a second, because there's a bigger philosophical shift happening here that ties all of this together. For decades, the approach to bank regulation was, when in doubt, add more rules, more oversight, more requirements. That era appears to be ending. The current regulatory direction is aggressively pro-deregulation. And one of the most concrete expressions of that is a concept called regulatory tailoring, the idea that not every bank should be treated the same. Right now, banks are sorted into 4 categories based on size and complexity. Category 1 being the absolute giants, Category 4 being the smaller end of large banks. The problem? Regulators and lawmakers have pointed out that some banks in Category 4 are being held to nearly the same demanding standards as banks that are 3 times their size. In November 2025, key congressional leaders wrote directly to the top bank regulators and said, "Fix this. You already have the legal authority to do it. So do it." And some regulators have already started moving. The OCC proposed raising the asset threshold for its most stringent risk governance rules from $50 billion to $700 billion. That's not a minor adjustment. That's a near-complete overhaul of who those rules apply to. The number of banks subject to those heightened standards would drop dramatically overnight. So what does this mean practically? For mid-sized banks, it likely means less compliance cost, which can translate into more competitive loan products for their customers. For community banks, the ones serving small towns and local businesses, there's potential relief coming in other areas too. The direction of travel is unmistakable. Lighter touch, more freedom, more focus on what actually matters. Which brings us to the next major shift. The Federal Reserve recently released what it's calling a statement of supervisory operating principles. On the surface, it sounds like bureaucratic housekeeping. It's not. These principles are a fundamental change in how bank examiners are supposed to do their jobs. The old approach, send in examiners, scrutinize everything, flag every procedural gap, every documentation shortcoming, every minor deviation from best practice. The new approach, focus on real financial risks, things that could actually threaten a bank's survival or damage the broader financial system, not paperwork. The new principles explicitly say examiners should not waste time validating whether a bank fixed a problem if the bank's own internal audit has already confirmed it. They should not hold open a corrective order just to test whether the fix sticks over time. They should prioritize significance, not volume, and they should stop conducting broad, sweeping horizontal reviews across groups of banks unless there's a specific, justified reason. This might sound technical, but the downstream effect is real. Less examiner time means lower compliance costs for banks. Lower compliance costs mean better rates and services for you. And a sharper focus on genuine risks means the system might actually be better at catching the problems that matter instead of drowning in a flood of low-stakes paperwork. Now, here's where things get really fascinating. While all of this is happening with traditional banking, there is a parallel revolution taking place at the intersection of banking and technology. In 2025 alone, 14 new applications for national bank charters were filed with the OCC. Many of them were in the digital asset space, and in December 2025, the OCC approved 5 applications for a new kind of institution, national trust banks, specifically designed for digital assets. These aren't your grandfather's banks. They can offer crypto custody, staking services, digital asset trading, stablecoin issuance, even gold-backed digital asset programs. And because of how they're structured, their parent companies don't automatically become subject to Federal Reserve oversight the same way a traditional bank holding company would. What should you actually take from all of this? Here's the real story underneath all the regulatory language. Banking in America is being restructured speed and scale we haven't seen since Tawin's Capital. Rules are being rewritten. Supervision is being streamlined. Digital assets are being pulled into the mainstream financial system. Consumer protection is in flux. And the people who understand these shifts, business owners, investors, financial professionals, and yes, ordinary people, managing their money are the ones who will be best positioned to navigate what comes next. These changes are not abstract.